The software sector just collapsed 20% in a matter of days. Crypto fell below critical support. Gold swung 17% in 48 hours. While everyone panics about AI destroying enterprise software or Fed policy shifts, they're missing the real story. Human predictability creating systematic opportunity. I've spent 15 years studying how fear and greed create exploitable patterns, and what's happening right now is textbook crowd psychology meeting leverage liquidation. This isn't random market chaos. This is the same pattern that plays out every cycle when three things converge: crowded positioning, narrative breakdown, and forced selling. The crowd believed software companies had permanent moats. They believed crypto was digital gold. They believed precious metals only went up during uncertainty. All three beliefs just shattered simultaneously, and the herd is stampeding toward the exits. Here's what actually happened. Enterprise software commanded premium valuations for years based on recurring revenue promises. Then Anthropic released automation tools that threatened to replace entire software categories. Investors didn't wait for evidence of margin compression. They fled based on existential fear. This is loss aversion at scale. The market went from pricing perpetual growth to pricing obsolescence in 72 hours. Meanwhile, crypto's breakdown below 80,000 triggered mechanical selling from algorithms and margin calls. $5 billion in leveraged positions got wiped out because late buyers who chased the election rally couldn't handle a 43% drawdown. The fear and greed index hit 14, extreme panic territory. But panic doesn't guarantee bottoms when structural buyers disappear. Gold's 17% collapse from record highs wasn't about fundamentals changing overnight. Chinese retail traders were using massive leverage to chase momentum. When Kevin Warsh got nominated for Fed chair, introducing hawkish uncertainty, the marginal buyers vanished and forced sellers dominated. The 6% rebound Tuesday was short covering, not conviction buying. The system is revealing its true nature through these liquidations. The Nasdaq dropped while the Dow held steady because investors are rotating from duration risk to tangible value. Walmart hitting $1 trillion in market cap isn't coincidence. It's the market rewarding businesses that can't be coded away. Software companies are hitting 52-week lows while consumer staples gain ground. This earnings season is punishing any hint of deceleration. PayPal dropped 20% on modest guidance. Disney fell 7% despite beating estimates. The market demands perfection because late cycle psychology has taken hold. Investors are paying for certainty, not growth potential. The delayed jobs report creates an information vacuum that amplifies volatility. Markets hate uncertainty more than bad news. Without labor data, investors can't calibrate Fed expectations, so narrative trading dominates. The 10-year yield pushed past 4.25%, pricing out rate cuts while the dollar posted its biggest two-day gain since April. Bond markets are telling us this isn't about economic collapse, it's about repricing assumptions. Strong manufacturing data shows the economy can handle higher rates, but leveraged positions built on dovish expectations are getting crushed. Private credit managers drop double digits because their portfolios are loaded with software exposure now being repriced. The Stoic approach recognizes this as wealth transfer from the emotional to the disciplined. Forced liquidations don't reflect fundamental value, they reflect leverage meeting uncertainty. The software sector's collapse isn't about AI destroying value overnight. It's about investors realizing they paid growth multiples for companies facing structural disruption. History shows these liquidation events create opportunity for patient capital. When fear dominates, quality assets get thrown out with speculation. The key is distinguishing between temporary dislocations and permanent impairment. Companies with genuine moats and pricing power will survive AI disruption. Leveraged momentum plays won't. The market is teaching its eternal lesson. Crowded trades unwind violently when narratives break. The speed feels disorienting, but the pattern is predictable. Excess gets purged through volatility. Leverage gets unwound through forced selling. Uncertainty gets priced at a premium until clarity emerges. This process isn't complete. Volatility begets volatility until positioning resets and new equilibrium forms. The system rewards those who remain disciplined while others capitulate to fear or chase false bottoms. If you value systematic thinking over emotional reactions, subscribe for frameworks that exploit human predictability rather than follow crowd sentiment. Download the complete Stoic exploiter methodology in the description. It's your guide to turning market psychology into systematic advantage.